Welcome to Alpha Recap, your quick daily download from stockalpha.ai. The markets finished trading a mixed session on January 21st, and today we're breaking down the sector rotation that really stole the show. I'm joined by Benjamin, our commodities expert down under. Great to have you with us.
Thanks for having me. It was an interesting session. Not a broad risk-on or risk-off day, but a lot of selective moves across sectors.
Let's start with the headline indices. The S&P finished the day up about 0.4%, the Nasdaq outperformed at roughly 0.7%, and the Russell 2000 was down about 0.3%. Give us the one-line read on that mix.
Sure. The quick takeaway was divergence. Large cap growth and media strength helped the Nasdaq outpace the broader market, while small caps lagged as bank and regional concerns kept investors cautious about higher beta names.
You used the word rotation earlier. Walk listeners through what that meant in plain terms today.
Rotation simply meant investors were moving money from some sectors into others within the same day, rather than buying the entire market. Today, they peeled away from riskier or policy-exposed names and shifted into income-oriented and commodity-linked groups. Practically, that showed up as strength in utilities, energy, and miners, places with steadier cash flow or exposure to rising commodity demand, and weakness in cannabis and parts of technology hardware.
Let's talk about the winners. Utilities did well. Why were they in favor?
Utilities rallied for two main reasons. First, there was optimism around renewable investment and grid modernization, which gives certain utilities clearer long-term earnings visibility. Second, in an environment where investors wanted steadier income, utilities, which often pay reliable dividends, were natural beneficiaries. Also, names tied to battery storage and transmission projects led the way because they look like the companies that will be building the grid of tomorrow.
Materials and mining also outperformed. What was behind that move?
There were stronger demand cues across industrial metals. Parts of manufacturing are restocking inventories, and logistical adjustments are supporting commodity demand. Plus, a Supreme Court tariff ruling, the so-called Greenland-related decision, clarified trade exposure for some manufacturers, which reduced policy uncertainty for certain miners and processors. That combination pushed miners higher.
Energy showed gains too, including renewables-linked names. How did energy rally alongside utilities?
Energy strength came from a mix of tightening supply narratives and the shift in electric vehicle supply chains. Integrated energy players and some midstream names benefited, and renewables-linked energy stocks caught a bid as investors favored companies that will participate in powering a greener grid.
On the flip side, cannabis names sold off and U.S. information technology hardware lagged. What drove those losses?
Cannabis stocks were hit by fresh regulatory scrutiny. Enforcement and licensing worries cropped up, and that reset near-term expectations for federal reform. With federal reform still far off, investors re-rated those companies. For IT hardware, softer demand signals and cautious guidance from parts of the supply chain weighed on the segment. When component suppliers flag weakness, it ripples through hardware names.
There was also chatter from Davos about crypto regulation that seemed to help Bitcoin-linked names. How much did that color the tape?
It provided a constructive backdrop. The messaging leaned toward more structured rules rather than heavy-handed bans, and that gave speculative crypto-linked stocks and infrastructure providers a tailwind. Those moves were more thematic and shorter-lived than the big sector rotations, but they did lift certain pockets.
Let's drill into individual names. Netflix rallied on ad monetization optimism. Explain why ad revenue matters beyond Netflix itself.
When analysts raised ad revenue expectations for Netflix, it wasn't just valuation for that company. Stronger ad pricing can lift margins across the streaming and digital media ecosystem. That helped communications and media peers, since better ad revenue flows through to improved profitability and investor sentiment across the sector.
Apple finished the day up after strong results in China. The note in the research said Apple took roughly 22% share in the fourth quarter there. Why did that matter to the broader market?
That kind of market share strength in China reassured investors that the iPhone remains resilient in a key market. It also helped suppliers and smartphone chip vendors because demand stability for Apple typically lifts the whole supply chain.
3M put out results with mixed signals. How did investors react?
3M's report showed some revenue softness in industrial segments, but management emphasized restructuring and portfolio optimization aimed at improving free cash flow. So the reaction was mixed: disappointment on near-term revenue, but some hope for better cash flow profiles going forward.
HF Sinclair had a notable institutional trade that sparked a sell-off in that name. Did that contagion hit energy broadly?
The trade in that single midstream name lowered its share price, but energy broadly still benefited from commodity tailwinds. It was an example of a company-specific move inside a generally constructive sector.
PVH got a positive reaction for margin stability, posting earnings per share around $10 for the year. Why did that matter?
PVH showed that discounting and supply chain normalization were improving earnings visibility. Investors liked the margin stability and inventory discipline. It's the kind of result that reassures those following retail and apparel earnings cycles.
Cannabis names like Tilray and Canopy Growth were lower on regulatory concerns. For listeners who follow that sector, what's the practical implication?
The practical implication was that until federal reform in the US looked more certain, investor enthusiasm would be tempered. Companies that depend on quick policy wins were repriced, and those with heavy leverage or weak balance sheets were punished more severely. That's why you saw a sector-wide re-rating rather than isolated moves.
We also had a handful of 8K filings that grabbed attention: Medical Properties Trust and Beneficient flagged governance items, and a gold mining 8K stirred miners briefly. How should investors think about these corporate filings?
8Ks can be catalysts because they reveal timing, governance, or transaction details that change risk perceptions. Market participants watch them for balance sheet or distribution implications, and in thinly traded or sensitive sectors, they can prompt sharp moves.
Switching gears to the macro picture, there weren't big surprises in the data today, but the market was positioned for a busy week ahead. What are the Fed implications traders were watching?
Traders were focused on inflation prints and labor market readings coming up. If inflation showed stickiness, that would complicate the Fed's path and likely push yields higher, which would pressure rate-sensitive growth names and could support financials if systemic bank worries eased. Conversely, signs of a cooling labor market would reinforce that policy was restrictive enough to bring inflation down, which would be constructive for utilities and real estate investment trusts, sectors that like lower yields.
You mentioned bank risk and regional concerns repeatedly. How does that factor into the Fed's room to maneuver?
Banking headlines keep a domestic monetary premium in place, meaning the Fed has to be data-dependent and cautious. If pockets of market stress persist, the Fed's path to easing narrows. So even with lower inflation, the Fed could hesitate if credit conditions are fragile.
Technically, the S&P stayed above recent breakout levels and the 50-day moving average. What did technicians make of that?
Technicians liked the stability. Remaining above the breakout and the 50-day average signaled short-term resilience, suggesting selective risk-taking rather than broad selling. Volume patterns showed rotation trades drove price action, classic when investors are waiting for macro data or big earnings beats.
So what did it mean for traders? The article suggested short-term and swing trade ideas. Can you summarize the trading implications in plain terms?
Short-term, the safest trades were selective longs in utilities, renewables-linked energy, and miners with solid cash flows. Traders were advised to hedge large-cap tech exposure because hardware was weak. For swing traders, media names benefiting from ad revenue upgrades and oversold regulatory hit names with credible recovery plans were opportunities. For longer-term investors, the advice was to prioritize balance sheet quality, especially in financials and cannabis, and favor companies with clear, free cash flow improvement plans.
Quick question on hedging. If someone wanted a simple hedge for large-cap tech exposure after today, what might that look like?
A simple hedge could be rotating a portion of exposure into sectors that tend to do well when yields rise or when investors seek income. Think utilities or high-quality materials names, or using put protection on concentrated tech positions. The key was not to overhedge and to match the hedge to the time horizon of your position.
Looking ahead to the next session, what were the primary risks to watch?
Number 1 was incoming data and any Fed commentary, inflation and jobs prints could move yields and shift sector leadership. Number 2 was bank and credit headlines. Any fresh stress among regional lenders could trigger more small cap underperformance. Number 3 was the earnings cadence. Surprise beats or cautious guidance could create dispersion and trading opportunities.
Before we wrap, give our listeners 3 clear takeaways from today's market action.
First, today was a sector story more than a market story. Investors rotated toward income and commodity exposure and away from policy-exposed names. Second, selective risk was in play. The S&P showed technical support while the Nasdaq led thanks to software and media strength, but hardware weakness kept caution alive. Third, the data calendar and banking headlines were decisive near-term risks. Markets were waiting for those inputs before taking a broader view.
Those are great. Any final practical advice for listeners positioning portfolios after today's close?
Use volatility to reassess balance sheet risk, especially in financials and cannabis. If you're trading, focus on sectors with clear cash flow stories like utilities and select miners. And keep risk management front and center. Meaningful sector divergence can create opportunities, but it also increases the chance of sharp reversals when macro data prints.
Perfect. Thanks for the clarity, Benjamin. That wraps our market recap for January 21st. Quick recap. Sector rotation into utilities, materials, and energy. Mixed index performance with the Nasdaq leading, headwinds for cannabis and IT hardware, and a busy data week ahead with Fed implications. Thanks for listening to Alpha Recap. We'll be back tomorrow with more market color. Have a great evening.